Hello, guys. Welcome back to another podcast by KayaPlus. So today we will be talking about the Central Provident Fund (CPF) and also the Employment Provident Fund (EPF). So, if you guys are not aware, so CPF is the EPF equivalent in Singapore and vice versa. So, the reason why we actually pick up this topic to talk about is actually there have been recent progress or potential new rulings and adjustments to EPF, which we are skeptical of. And I think it's also a very good time and period to actually prove our point why it's not that good, and by bringing in CPF as a comparison, as a yardstick. So if you are not familiar, you might always think that what KWSP or EPF do is the right thing, but if you compare, you have someone to compare, then perhaps you can actually think twice, or even plan your KWSP or EPF arrangements much better. So I'll pass on to Chubing. What is actually happening to EPF, and what is actually the most basic information that Malaysians need to know about their EPF?
Yeah, I think it's quite interesting for me personally as well because I didn't know much about CPF. The whole thing about retirement fund for me is EPF. But then just to start the conversation and make it easier for you to compare side by side, we will basically see from a few angles. So of course, I mean, if you are new to uh the society, you just start working and then you realize you have been contributing to this retirement fund on a monthly basis. Basically, this is some of the key information about EPF. It's, it's quite straightforward. Is you are, I mean, it's basically a mandatory contribution by law. So meaning on a monthly basis, if you are a working adult, you need to contribute from your end, and the employer also need to put in certain percentage, and eventually all this money will be utilized by the fund manager, in this case EPF, to go and invest anywhere. And then of course the return will be giving back to you. And of course for Malaysia it's quite straightforward. You basically have two type of account. They call it account one and account two. And account one will basically consist of 70% of your latest saving, and the rest is actually account two. And account two is the one that allowed you to do more flexible stuff. Some of the example is you can withdraw it for your, uh, let's say, to serve your mortgage. Some of it you can apply it. There are lists of things you can do with account two, and of course, account two is also the target. During back in the day during pandemic, you can actually do a withdrawal from it to basically gain enough money to go through the tough period. But then we won't talk about it in details yet. The key thing I wanted to give you as a heads up is there's a plan to basically introduce account three as well. But then the details is not yet being outlined. So this is quite simple from a structure perspective. But then I'll be interested to know from CPF perspective, what is the concept set up by Singapore government, and what is the basic structure of the whole fund? Maybe Jupan, you can take us through the
Yeah,
example
I
in
think
CPF.
when you talk about retirement, wherever you are around the world, we always share the same concerns, right? The first thing is that you want to make sure that you don't want to be burdened by any debt mortgages when you're old, because you're not working and you are retired, and whatever assets that you previously owned via that, it should be cleared so that you don't need to actually, get troubled by it. And then that is the first part, which is to have a house that is debt free and already cleared, and you can actually, stay there until you the end of your days. The second part would be healthcare. So when we actually grow old and we age, health problems will actually come for most of us, and there's also a need to have cash buffers to actually help us go through whatever medical expenses or hospitalization that we are required of. Of course, we also will top up whatever insurances we have with our insurance providers. But the very basic healthcare insurance forms a component within CPF as well. And lastly, when you retire, you will not be working, but we still would need income to actually sustain our lives. We still need to go through our day-to-day expenses. So there is a need for a sustainable and also reliable income stream to help you retire whatever expenses you might need to incur for the rest of your life as well. So these three big concerns are actually targeted and addressed by the CPF account. So the CPF account is actually made up of three major parts. So you have your ordinary account, your OA, your special account, your SA, and also your MediSave account, MA. So MediSave account, straightforward from the name, it's really for whatever hospitalization and also healthcare related expenses. Ordinary account, some of or most of the people actually utilize this part to actually help to pare down their mortgages, their home loans, so that it does not take too big of a hit from your monthly income cash flow. So the other one, the special account, is the component that most people don't usually touch, although you can, but you will need to qualify certain thresholds and also certain requirements before you can touch it. But basically, special account is there to really guarantee your retirement income when you hit age 55. So when you hit age 55, OA and SA will combine and give you your RA, your retirement account. And this is where you actually start to really plan and anticipate your retirement income via that component.
I wanted to understand, it means that when, the Singaporean or the Singapore PR, when they reach age of 55, they can do a full withdrawal or they cannot? Because, so what does it mean? Meaning, if let's say I have I have a 1 million saving by then, the submission of the OA and SA. So how it works after I reach the age of 55?
So most of the portion of it will go to your retirement account, and your retirement account will still continue to accrue interest. Later we talk about the interest portion, and you can only take up whatever portion that is within the limits that is actually for you to sustain your life. So the ultimate reason and goal for retirement income is not for you to fully utilize whatever you have saved. So there will be a situation or there will be a condition if you have not accrued enough amount of capital inside your CPF, you might not have sufficient retirement income to sustain your life. And this is where you might need to accept the fact that to continue to survive, you might need to pick up some odd jobs, right? So the system is placed in this way that they will not allow the account to totally become zero. So if you have not put in hard work during your prime age and prime period to beef up your CPF account, then you will be looking to experience a very, very painful retirement.
Yeah, I think this is quite interesting because in Malaysia, the knowledge that we have since small, because we hear from our parents or whatnot, is when you hit your retirement age, actually you can have an option to withdraw it at a lump sum, and then of course you manage your fund whatever way you like. I think it's quite interesting. So later we touch on this on our view on this structure. What is the pros and cons using our own opinion. But then the next thing I wanted to do a quick comparison is about the contribution. So in Malaysia, it's quite straightforward. The contribution is basically shared by the two parties. Of course, one of it is you yourself, the employee. And then, of course, if you are the employers, you also need to contribute part of it. So in Malaysia, it won't go in a very far difference. So it'll be 11%, 13%, or 11%, 12%. Depend on your monthly salary rates, and of course depends on your company policy. But this is quite straightforward. It's about 10% of your income going into this kind of contribution. How about CPF? Is it also 11%, or actually it's more than that?
Actually, it's almost one time more than that. So for Singaporean citizens and PRs during our prime, which is if you are 55 and below, your contribution to CPF is actually 20% of your monthly wage, right? So on top of that, your employer will also put in additional 70%. So this is where the capital accumulation phase starts, right? So every month you actually get 37% of your gross pay credited to your CPF. It will be split to the OA, SA, and also your MA account. And then you continue to do this until you reach 55 years old. And then you see right there in the table, 55 to 60, even you're still working, CPF also knows that it is time for you to also readjust your monthly pay and also your expenses to prepare for retirement. That's why you can see that the overall contribution from employer and also from employee side has also decreased accordingly. So to actually allow you to have much more disposable income on hand to settle whatever you need to settle instead of letting it accrue inside the account, because the accrual and accumulation phase will have happened if you are 55 and below. So that is a golden period of your time for you to actually boost up your CPF account.
Quite interesting. It's almost double of the Malaysian numbers. When you talk about the contribution go to OASA, I mean, what does it mean?
Yeah. So because we are aware that to retire comfortably, you need to have a house that is debt free. You need to ensure that you have a sustainable, consistent retirement income to help you go through your daily expenses, and you also need to ensure that you have a portion of your savings that will help you service whatever hospitalization and also healthcare insurances, right? So your monthly pay, the 20% will be split in a certain ratio into your OA account, SA account, and also MA account. And each of these accounts will have a fixed interest rate of appreciation. So it will be accrued on a monthly basis. So meaning to say that it's not annually, so it's monthly. So long as you contribute much more in the beginning of the year, the amount will continue to compound on a monthly basis. And this is actually the interest rates for OASA and MA. So 2.5% per annum for OA and then 4% for SA. So if you're just started to contribute, the total amount of your CPF is below, say, for example, 20,000 for OA, so you're actually going to get 5%. So there is a kind of helping mechanism to help you hit your OA account to be above 20,000, and then only you reverse back to the normal percentage. And when you hit 55 years old, of course, you can see that the interest rates will also be adjusted as well. Your SA and MA will your SA and OA will combine to become your retirement account. And then if it's below a certain threshold, the interest rate will also be higher. So why Singaporeans previously had doubts is actually because you need to actually put your money in for a very long time until you can enjoy it. And I think previously, a few years back, there was an issue raised out by the opposition party that it is impossible for Singaporeans and PRs to actually, take out their CPF. But I think over the times, as the general public goes more educated, it has slowly become to be one of the solid foundations for Singaporeans and PR to build upon their retirement planning.
But the monthly figures that able to get when you hit your retirement age, how is it calculated? Is it based on, because let's say you have a 1 million in saving, how much am I going to get per month? This is something that I don't really understand how CPF actually works. Is it a $500,
It will
$1,000?
be a percentage. So the gist of it is that you do not draw out what your interest can earn you. So if your interest can earn you this much, the golden rule is that you just only utilize the interest portion or even a little bit more so that you won't end up in a certain date in the future where your capital is run out and then you suddenly don't have anything inside your CPF. So there is a much more complicated way of determining it. Basically, your sum inside your CPF will be categorized into BRI, basic retirement income. So this is actually a figure that you hit that actually will allow you to generate or withdraw this type of salary or income monthly to sustain your daily lives. So on top of basic, you have enhanced and you also have the ultimate version. So depending on how much you have, the more you have, the much more amount the returns are generated and the much more you can withdraw out. And of course, your quality of retirement life will be better because of that. Just very straightforward.
It it's quite interesting, though. But then, of course, the argument will be, this is my hard-earned money. I contribute so much throughout my the 10 to 30 years in my life. But then I cannot withdraw it to enjoy. But I need to comply to this kind of calculation. I mean, they're good and bad. But just to give another sharing, to give you a side-by-side comparison. So the return of EPF isn't that bad. If you compare to CPF, even though CPF is actually fixed, but then from the historical performance perspective, EPF has been always able to hit above 5. Of course, the recent years seems to be a little bit underperformed, but then it can be due to a couple of reasons. So this is just for reference. So the latest one that we have hit is actually 5.35 back in 2022. So this is the one that you can compare, but again, the magnitude of it is of course much smaller if you compare back to CPF, because the contribution itself is low at the first place. But then the next thing I wanted to touch about is something on how the fund managers actually utilize the fund to create income out of it. I'll start with the example from EPF, and of course, how they are able to actually get their return is basically they invest everywhere. So if you're interested to know what is the company actually invested by EPF and what is the percentage hold by EPF, you can actually go to their website and check out the investment tab. So this some of the example that you can see. This is like the top 20 in terms of percentage holding by EPF. Of course, if you follow the latest news, recently they also put in a lot of money to buy Farm Fresh. Farm Fresh actually, the share price dropped these 2 weeks. So this is some of the thing for your references. But again, another interesting movement is our PM Anwar actually give a message, and he hope EPF to focus their investment in the local markets. So he actually hope to reach about 70% this year. For me, it's a 50-50 in my opinion, because you'll be losing out some very high growth markets if you basically use all your money going back to Malaysia. But again, another perspective is if this money is being used in the right way, and of course, the local market will have more money to basically develop, be it infrastructures, attract more business opportunities. We'll see how it goes. But this is a major change from the previous practice actually done by EPF. And then, of course, maybe over to you, Jupan. What is the way that CPF actually generate the money and allowing them to basically give out a so-called fixed return to the members?
So basically, due to the fact that CPF returns are fixed, in a way, you are actually putting your funds and letting it getting invested by GIC. So GIC is a government sovereign wealth fund, which is similar to Khazanah in Malaysia. So what CPF will do is they will actually invest it to what we call the Singapore special Singapore government security. So it's actually like a bond, right? It's actually borrowing money to the Singapore government, and GIC will take the money on behalf and help to invest. So the investments can be stocks around the world, whatever investments that suits the risk profile, the risk reward of GIC to ensure that Singaporeans and PRs actually get their fixed returns in their CPF for their retirement. So, of course, it will be long-term kind of investments, and this has been going on since 1981. So that's why, due to the fact that in certain ways, Singapore government is relatively solid and strong. So whenever Singaporeans want to calculate risk-free returns, they'll always use CPF as a benchmark to as a yardstick to compare against other kind of investment returns to get a gauge whether is it the risk and reward ratio is justified. Yeah.
Understand, quite interesting. And of course, Singapore government is trying so hard to basically keep the saving in control so that they can actually help the citizen when they reach their retirement age. They can
Yep.
have some form of money to help them with living. And of course, they
Mhm.
encourage not to withdraw more than the interest so the whole thing
Yep.
can keep on going in the compounding effects.
Yep.
While on the other hand, Malaysia, I would say this is one of the things that I find it a little bit shock and also uh, a little bit disappointing on the fact that this is the policy being issued. But of course, they're the good part of it. But in my very personal opinion, this can be an act or an action that cause a very, very long-term negative effects. So remember a few years back, pandemic, everyone suffer. And then I think Malaysia is one of a kind that allow you to withdraw from retirement fund uh, multiple times. So the key thing is not just one time. If you apply for it, you're entitled for it. You can basically withdraw out a lot of money from your account two, which is the one that's more liquid, 30% of the fund. To some extent, I think it allowed you to go from account one as well. So these are some of the shocking figures as of June 30th of June 2022. There are 6.62 million members under the age of 55 still working, have less than 10,000 in saving. So you think about it, if let's say this guy is 50 years old, there's another 5 years for him to work. Let's say he accumulate another 5,000. So when he reached the retirement age, even though he can withdraw lump sum, it's just 15,000. How do you survive with 15,000? Let's say your life then is you have another 10 years with you. So it will be close to impossible. And this is why I mentioned there's a negative impact in long run is because when this thing happen, there will be more and more people required special help or relief from the governments. They will need to get some funds from the government so that they can actually live a basic life. But this thing will go on and on. And on the other hand, because all these funds actually go out, then EPF don't have enough asset to actually don't have enough fund to buy on the good asset. If you remember those days when this thing is allowed, you're seeing a lot of share being actually sold by EPF down to some fixed properties. They also let go so that they can have enough fund for withdrawal. So I don't know about your view, Japan, but for me, in a very personal level, I don't think this is the right action, even though maybe for good reason. Yeah.
I think the reasons why pension funds exist is due to the fact that most people are not very good in terms of planning for retirement and managing their money. So that's why there is a blanket rule for everyone to actually enroll into a pension fund, right? Of course, when you hit retirement age, whether you can take lump sum or not, that's also another question. But I think the gist or the rule of thumb stays the same. If 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 the reason of pension funds is due to the fact that a lot of people don't know how to manage and plan for their retirement, do you think allowing people to do one lump sum uh, of their EPF when they reach retirement will justify them planning their retirement life accordingly? I don't think so. So I think that is the reason why Singapore CPF doesn't allow that, and it's a cruel, but I think necessary way to ensure that everyone, even those who don't plan, at least the system is there to help you plan um, accordingly without you actually screwing up your retirement. So I think that is the reason why you need to have systems and measures in place to actually safeguard everyone's interest.
Yeah, I think you need an iron view, and of course, you need to have a huge support from the peoples that are giving you the mandate to actually govern the country so that you can do whatever thing freely. So just to express some of the findings that actually found by, I mean, over the past few months is a bit contradicting and interesting at the same time. So if you take a look, and one of the news actually released, or one of the statement actually released by our prime ministers, uh, he's basically saying another round of special EPF withdrawal will not be supported, uh, and then he's against it, which is something that I think is a right move. But fast forward today, there are a couple of news being pop up as well. Right now, they plan to actually introduce another thing called account tree that allow you for immediate withdrawal, which this account tree act like a saving account. You put this in, let's say 5% of it go into your account tree. This is like a saving account you can withdraw anytime you want. So even though there are some thought process, there's something that the government trying to do, but of course there are a lot of noises from the ground, from different parties. I think this is a give and take that we need to actually see going from time to time. So I don't know to what extent this account tree will behave. Hopefully, it's not big figures that allow you to withdraw 10% of your EPF anytime you want. Because in the long run, I would say this is something that will actually haunt you in long run. And of course, there are also rumors saying moving forward, the government plan to limit the so-called lump sum withdrawal at the age of 55 or 60 for existing EPF. And again, don't know, is it because of the state election that's coming soon? Again, a statement actually released by EPF saying no changes to this, everything remains the same. But for me, I think for you to retirement in a reasonable manners, sometimes you need an external factor to actually help you to do the things. Because if the fund with you, you would go for doing a lot of something, a lot of things that you may not know is either good or bad in long run. So you may take this thing to invest into something that you don't know, and then you lost the money. Or you take this thing to enjoy the moment, buy something that you may not use for long run, but again, you just enjoy the moment. So from a retirement fund perspective, you really need the iron view from the government to do the right thing. Else, as a layman or the public person, unless you are really disciplined, else it's a bit hard for you to manage yourself if the full fund actually into your saving account. And then you might do a lot of silly things. But of course, there's a session for us to share with you the differences between EPF and CPF and how the different government managing the money on behalf of the citizen and what is the so-called short-term and long-term effect for withdrawals. Yupan, do you want to add anything before the end the session?
Yeah, so I think for those who actually have your EPF, I hope this video actually give you time to think about it, some thoughts before you actually just withdraw for the sake of withdrawing. Um, do know that retirement income, retirement fund is really for retirement, and it's not for you to utilize it for other means and other reasons. So if you look at how Singapore is actually doing it, um, and the very fact that it is a successful model, and even as a Malaysian, after going through the EPF and also CPF, and personally now and being enrolled into a CPF program, I think the logic makes sense. And even though I know how to manage my money, I am very thankful that the system is there to keep everything on track. So, of course, let us hear your thoughts. Do you actually support the EPF's decision to allow further withdrawal? Let us know in the comment section. And do you think that the EPF model should be as strict as the Singapore CPF model? So let us also know in the comment section. So if you like the video, give it thumbs up, smash the like button, and also share it to your friends and family, your relatives, and also help them realize that it is not wise to actually squander away your retirement income just because public pressure or the continuous withdrawal of the EPF account. And of course, do subscribe to the channel as well, as we will also post similar videos and have similar kind of sharing session, not only from investment point of view, but also on managing retirement income and retirement accounts as well. So we'll see you in the next video. Take care. Bye bye.